Hey, what's going on, guys? Adam here, and welcome to the video. We're going to talk about an order of operations that you can use for the money that you set aside for investing to help you squeeze every little bit of value out of it that you can. This strategy is best used for people in their 20s and 30s, but the overall concepts apply to any investor. Ultimately, it depends on your overall financial goals. So with that all said, let's get into it. The first thing that you should do is max out your employer's 401k matching if you have access to one. There are many variations, but an average one is dollar for dollar up to 3% of your salary. So let's say that's your plan. You should set up your matching to have them contribute 3% automatically out of each paycheck. If you do this, your employer will pay the exact same amount into your 401k on top of what you've already contributed. It's literally free money. Man, that went everywhere. Don't worry, it's not real money. Let's say your salary is the average in the United States, which is $50,000 a year. If you contribute $1,500, which is 3% of your salary, they're giving you another $1,500 for free for doing something that you're already doing anyway, saving for retirement. You double your money for a 100% return on investment right off the bat, which is much better than anything you'll find on the stock market. Unless you bought Tesla stock back in March, which tripled in price in about 4 months. Crazy times we live in. In addition to the immediate 100% ROI, you also get all the usual gains from owning those investments like price growth and dividends. This is the biggest no-brainer on this list by far, besides petting the like button to pet the YouTube algorithm. It's quick and free for you and it'll help the channel out a ton. So anyway, please, if you do nothing else in this video, max out your employer's 401k matching. The second thing you'll want to do is max out your Roth IRA contributions. You can do a traditional IRA instead, but this is only recommended for people who don't think that their taxable income will increase, which is mostly people approaching retirement. So basically, you always want to choose a Roth in your 20s, 30s, and even 40s, since you are probably expecting a higher salary and a higher taxable income before you retire. The contribution limit for 2020 is $6,000 across all of your IRAs, both Roth and traditional. So this is why you have to make a decision between the two. You either take the red pill or the blue pill. I explain the differences between them more in depth in my video about how to legally avoid taxes. Both IRAs come with their own tax breaks, which is the government's way of encouraging people to save for retirement. Roth IRA contributions are post-tax, meaning that you already paid income tax on the money, which, doesn't seem too great. But the reason that you want to use it is because you don't pay a cent on the profits when you go to sell. This is extremely powerful because you most likely will have made a lot of money over the years that you've invested in it. Don't let the government take your money. $6,000 a year is a lot of money, but if you contribute as much as you can, you will be swimming in it later. The third thing you'll want to do is max out your health savings account or HSA contributions. These are primarily designed to help pay for medical expenses, but their optimal use goes beyond that. Despite the name health savings account making it sound like a bank account, it's actually a lot more like an individual retirement account, and you should treat it like one if you can swing it. The contribution limit is $3,550 for individuals and $7,100 for married couples. The cool thing about this account is it is triple tax advantaged. First, contributions are tax deductible like with a traditional IRA, which means that they lower your current tax bill. Second, you don't have to pay for any tax on the profits like a Roth IRA. Third, you can withdraw it penalty-free for a lot of common health-related expenses, which you cannot do with any of the other accounts. These funds also last forever. There's no yearly rollover limit, so they will just keep growing and growing and growing just like your other investment accounts. So you might be thinking, well, what if I never use it for medical expenses? This is a very unlikely scenario, especially as you get older, because you will almost certainly have some kind of medical expense. But okay, absolute worst case, it basically turns into a traditional IRA where you're just taxed on the profits, which is still better than nothing. Plus, there's some pretty crazy things that are considered qualified medical expenses. I have several colleagues who purchased an Apple Watch, since it has a health monitor, with their funds from their HSA. With some clever accounting, there was even some guy who used this to buy a boat. Yeah, I'm not even kidding. It's pretty ridiculous. So even if you're healthy, it's just great to max these out. The fourth thing is something that you can consider doing, but it really just depends on your personal situation. Up until this point, you've ideally been contributing to your 401k up to your employer's matching limit to get that free money. After that, you can go back and max out the rest of your yearly 401k contributions. The contribution limit for 2020 is $19,500, which is relatively high compared to the average salary in the United States, which is $50,000. That's almost half of the pre-tax income. Luckily, these contributions are tax deductible, so they lower your tax bill at the end of the year. The main drawback is that you are contributing to a retirement account, so that means most of your funds will not be readily accessible for, say, a down payment on a house. This is why it is optional. You definitely can max out your 401k contributions for the year, but you really need to consider what your short-term financial goals are. Like, I'm looking to buy real estate soon, so I personally don't do this. I only go up to my employer's matching limit. The fifth and final thing to do is to put any remaining money into individual investment accounts. These are nothing special, just plain old regular taxable accounts that you can invest your money with. The money in there is pretty liquid compared to the other options, and it's fully accessible with no restrictions or penalties. This is where you want to keep your assets for short-term goals, like in my case, it's for a down payment on real estate. So there's your order of operations for the money that you set aside to invest. Max out your employer's 401k matching, then max out your Roth IRA contributions, then max out your HSA contributions. Then you can go back and max out the rest of your 401k if it fits your goals, and the rest just goes in a regular individual account. And of course, you can massage the numbers based on what is best for you. Hopefully you found these tips helpful to optimize your investing. Let me know what your strategy is in the comments because everyone's is different. I'll catch you in the next one. Take it easy.